Hey, I'm Dan Westfall. My company's Client Focused Financial. So today the conversation I want to have with you is geared around people that are in the market to buy a new house and are considering not getting a mortgage on that house because they have money set aside in savings or an investment account that they plan on pulling that from to just outright buy the house in cash. So I want to explain to you why this is just a bad idea, because not only are you not leveraging your credit, but you're also missing out on the opportunity to make tens of thousands, if not hundreds of thousands of dollars extra over the course of that 30-year loan, potentially if you took a 30-year loan out, if you were to just reinvest that money. So currently right now, mortgage rates are roughly around 4.5% for a 30-year fixed rate. So that's extremely low when we're talking historical perspective. If you've gotten a loan or a mortgage within the last 10 years or refinance within the last 10 years, you're likely in the 3% range or very low 4% range, which it just means that you're paying even less than where somebody would be getting a loan right now. But what I want to talk to you people about that are maybe thinking about just buying a house outright in cash is what you could do with that cash instead of just dropping that into a property. Give you a different sort of idea to think on that will help you make a lot more money with that cash than just dropping it into a property. So being that I'm an investment advisor, I always think through the lens of, where is money going to be, where are you going to make the most out of your money with spending every single dollar or investing every single dollar. So in the case, if you were to get a mortgage right now at 4.5% for the 30-year duration, if you were to take that lump sum that you would have put down into that house, just buying it outright in cash, you just put that 20% down so you avoid the PMI and all the nonsense associated with that, and you reinvest the other 80% of that money. If you were to reinvest that into a portfolio that is even conservatively invested at 6% all the way, up to a more aggressive portfolio at maybe 8-9%, you're gonna make a lot more on your money over a 30-year time stretch. So, and I'm not pulling those numbers out of thin air. The chart, you can see kind of half of it behind me, are the historical returns for the last 90 years within the market. The very top line, which I know you can't see the full thing, shows a 10% rate of return for the largest 500 companies in the US in the stock market. So that's over a 90-year time stretch. That's a pretty long time to look at, and there's obviously ups and downs over that. But even scaling that back to where it's a little bit maybe more conservatively invested within a mixture of bonds and stocks and other types of investment classes, you're going to make a lot more than 3.5%, 4.5% over a 30-year stretch of time, just if we're looking at historical averages. So don't make that mistake in doing that, because it just doesn't make sense, and there's a lot better, more efficient way that you could put your money to work than just dropping it into a house. If you have specific questions about mortgages, I'm not a mortgage originator. Reach out to my boy Dom, though. I put his link below. He is a mortgage originator. He'd be happy to have a conversation with you about any specific mortgage-related questions that you may have. If you'd like to take the investor assessment on my website, there's the link for that. Under the Insights tab on my website, on there as well is where I post all these videos that I put out every week. Feel free to go back and check any of those out if you're looking at any other financial topics. If you have specific questions for me, feel free to DM me, shoot me a phone call, whatever works for you. I'd be happy to have a conversation with you. Again, I appreciate you taking the time to check me out.